find a lot of videos and a lot of content out there around the pitch deck, around how to write a decent pitch deck, and how to prepare for investors. You can even find demo days and recordings of that. But once you get into the nitty-gritty of fundraising, of actually talking to investors and going through that process, not a lot of people have gone through that process, and not a lot of people, honestly, or people who go through that process don't necessarily have the time to share how it goes. So that's why we have this session. This is just me small talking for a little bit to allow people to tune in. But now we're live on YouTube as well on the Startup Club channel, and I see a good crowd on the Zoom link. So let's get started. Okay, so yeah, people generally think that pitch deck is this straight line from finishing a deck to funding, but sorry. But in reality, it's this tangle. And we understand this tangle now because we've been running since 2014. We've raised some venture capital ourselves. We've helped a bunch of companies do the same. And yeah, we've sort of identified these red dots, red flags throughout the process, which is what I want to talk about today. Okay, so let's of course start with the pitch deck. A bit, maybe a bit of an exercise to break the ice and kind of get you guys to interact and to see that this is not some robo recording. Let's do a little exercise, a little trivia thing. What's wrong with this slide? I'm going to put a slide on you, and please drop it in the chat, drop it in the YouTube comments. What do you think is wrong with this slide? I'll give you guys a second. No takers. A little bit of this is a TAM slide, of course. Target, TAM, total addressable market. What do you think? So the market assumption is wrong. I see Nicole needs bottom up TAM. It's top down, not bottom up, too broad. Guys, you guys are today's crowd is on. That's exactly correct. That's what's wrong with this slide. So $620 billion is not a TAM slide. The TAM slide should answer a simple question, or a rather simple question, which is how big your business get? How big does your business get? And by just saying that there's a $620 billion market of early adopters in the States, that doesn't mean anything against what you're doing. So that's just some irrelevant number. The penetration number is mostly irrelevant. So none of this stuff really relates to answering the question of how big your business gets. So great job, everyone. You got it. I have one more for you. One other slide. So what do you think is wrong with this slide? Hey, Suraj, on the YouTube stream. All right, drop your comments. I'll give you one couple more seconds. Maybe there's a bit of a lag. I know there's a bit of a lag with the YouTube people, but bear with me. I'm reading. I see we've cut up. So no strategy, just tactics, says Diego on the Zoom webinar. These are just general channels, not ones that have worked with your startup, by Andrew. I'd say also too broad, by Amanda. Too generic, nothing specific, by Rose. Yeah, absolutely on the right track, guys. The idea with the go-to-market slide is that it should tell the investors what quite unique strategy your company has come up with to beat the probably existing competition in your space. So how are you beating the competition? What are you doing that's better than them, that they don't understand, that they don't know how to do, that only you can do because you have the right connections or the right network, or you're insane at marketing, or you have the right team? What is this differentiator that you have that makes you better? That's what a go-to-market is, or what a go-to-market slide should be. Absolutely not just a list of 10 marketing tactics that are just not taking you. That you might want to try, like everybody has to do some form of social media, right? So that's not even a strategy. It's just like maintenance stuff. Okay, so great. That's a good exercise. We got warmed up. So the next thing I'll ask you, and just for you to again drop it in the chat, just tell me, where are you struggling with the pitch deck? I can focus some of the slides and some of my comments over the next bit of my presentation around one of these three areas. So area one is story. So if you're struggling with summarizing the story or compressing the slides into 15 or 20 slides, or figuring out what to include in a pitch deck, just write out story in the chat. If you're struggling with specific slides, so like the TAM slide or the go-to-market slide, we just saw those, or the financial slide, just drop that in the chat. Just drop slides and maybe the slide that you're struggling with. And if you're struggling with design, kind of like looking for design inspiration, ideas to make the pitch deck look better, drop that as well. I'd like to get a good sense of the group, and that way I can, I can focus on whatever is most useful to you guys. Okay, I see story. I see go to market on webinar. Diego's story. Okay. Story. All right. Okay. More story, Michael. I'm sorry, Michelle. Okay, great story. We're going to talk about story today. Okay. So just, whenever you're struggling with story, you take a moment, zoom out, and run through this question. So a pitch deck is a company story, right? It's a story of what the company has accomplished and a vision for what the company can become, right? Sometimes things get a little technical when you try to do TAM and when you try to do one thing or the other. So that's not what um, don't be distracted by that. Like, don't zoom out for a second and don't get stuck in kind of like one very technical slide, but rather zoom out from time to time to just understand um, how the pitch deck is accomplishing this. And this is really the hack that I'll give you. And please feel free to screenshot this slide. We want to make this diagram we want to make this diagram somewhat popular, and we want people to use it because I think it's 10 years doing pitch decks, and only last year we came up with this. But it's the ultimate culmination of what we've learned. So this is, to me, the perfect pitch deck story arc. If you divide those 16 slides or those 15 slides into that block, you have an intro, you have a status quo, you have a solution, you have market, and you have the why us section. I'm going to go through what each section has in terms of slides in a sec, but take this chance to do a screenshot of this. Okay. Okay, so let's talk about each section. Really, like, don't feel like the order of this structure is a rule. It's not. Rules were made to be broken, but it is a really good structure, and it does help companies kind of tell a better story, or at least make a story that's cohesive and it makes sense and that it flows pretty well. Okay, so normally you start with the intro section. I don't stop a lot there, just to say, well, there's a cover slide, obviously. Don't waste this cover slide. Talk about your business. Talk about, give us a one-liner of what the business does. Don't make that your marketing slogan, because marketing slogans are sometimes not immediately obvious. Like, I don't know, McDonald's marketing slogan is "I'm loving it," and that doesn't tell you that it's a fast food chain, right? So fast food chain is what should be in the cover slide, not "I'm loving it." Next up, traction teaser. So if your company is doing really well, if you have some really exciting growth metrics to show and to brag about, traction teaser is a good slide to come up next. Don't overcrowd it. Don't try to explain everything. This is really just a hook to get people to stick around. It's like, oh, this happens to me sometimes. Like, I'm looking through a pitch deck. The idea looks mildly interesting, but I'm not particularly excited. Some investors might be scrolling through these slides and not feeling any particular feelings about this deck. And then suddenly you go to the traction slide and there's this insane growth, right? And it's like, oh, wow, this company is doing really well. So I would argue that it's worth bringing some of that traction as a teaser early on in the deck, but very much optional. So gray in my little diagram means optional. And next up, executive summary. You'll read a lot of blog posts talking about how to write an executive summary and make sure that you include one. I hate executive summaries. I feel like it's those movie trailers that spoil the entire movie. And then you have to compress 15 slides into one slide. Why would you do that? Just like leave it with 15 slides. That's what the deck is for. So avoid executive summaries, in my opinion. Okay, so let's go to the actual sections. First section is the status quo. And again, if you're struggling with the section, and even before you jump in, make sure that this section answers this question, which is what opportunity have you discovered in the market? What's going on in the status quo? What's going on in the system, in the market, in your business, in your country? What's going on that's a painful problem that a business could solve? That's the ultimate question there. Okay, so normally the slides that would go in this section are a market overview, which is kind of like an introduction. Maybe, if you're pitching to an investor that may not be that familiar with your ecosystem, with what you do, with your industry, then it could be worth adding a market overview slide. But beyond that, it's usually done with a problem and or a business opportunity slide. A problem is, hey, like, here's the pain point that people are experiencing or companies are experiencing. They're wasting X amount of money or they're wasting X amount of time. It should be a really painful thing, not just like, oh, an inconvenience. It's like, this is really painful and there's a real opportunity to make money by solving this problem. Some businesses don't solve problems, right? Some businesses just tackle an existing business opportunities. My first startup was a mobile app, a mobile game, and games don't solve any problems. Games just tackle on business opportunities. And in that case, this was back in 2011. We were tackling on the business opportunity that the iPhone represented for mobile gaming, right? So could be a business opportunity too. Normally, most of the time, I'd say 80% of the time, it's a problem that you're trying to solve. Okay, next section. Next section is solution. So solution is this section should answer the question of what have you built to tackle this problem you just talked about? How does it work and who is it for? This is normally the section that founders find easier to solve, because it's just talking about the stuff that we're building and the stuff that we're working on. So that normally comes rather easy. So some of the slides that you can include here are solution, product, optional, a demo, how does it work, optional, their tech infrastructure, if there's something special about it that's worth talking about, target audience, crucial slide, a lot of people forget about it, case study, if you're selling B2B, a good way to kind of explain what your business does and tell it to people is by just giving them a case study. Hey, like this company, this business adopted the product, it took us this month to implement, and after a 3-month pilot, this is what happened later, right? So that's a good way to kind of understand where a product fits in the ecosystem, and it fits for your product, for your customers, but it also shows that you have customers. It shows that you understand those customers, that you understand those customers' pain points, and then you know how to plug into their workflow, right? So that's a great example of your products and working, but that's not always applicable. Business model is a slide that I see people struggle with a lot. It's honestly one of the easiest slides on the pitch deck. The business model is really just how you make money. So don't overcomplicate it. Don't think of projections. Don't think of how many customers you need to be profitable. Don't go all the way to that. Just give us how you make money. It's a subscription. It's usage based. Here are the rates. If it's an e-commerce platform, what are your margins? What are your expected margins? That'd be interesting. Your gross margins, of course. But aside from that, it's a pretty straightforward slide. And the last but not least, roadmap, just telling us, part of this money that you're raising is going to give you money for the next few months. So what are you going to do with that money? That's where roadmap comes in. And roadmap is a good bridge to the next section, which is what I call the market section, which again should answer the question of how much are you growing and how much are you going to continue to grow? Again, if you're ever struggling with a section or with a slide, zoom out, understand which section you're working on, and understand the core question associated with that section. So normally slides that go here are the traction slide, a proper traction slide, talking about your revenue, going into more detail about now that we understand what your product is, now that we understand who you're selling it to, now that we understand your business model, well, now it makes a lot of sense to finally talk about traction, and just that traction starts to fall into place. Everything starts to make sense. Unit economics, if you're not familiar with the term, is the amount, it's just like the economics of converting customers, usually on the acquisition side. So very much tied to the go-to-market. We talked about the go-to-market already. It should be the one unique strategy that makes you special against your competition. Maybe one, maybe two. If it's three go-to-market strategies, it's probably too much. Normally, good decks that I see show like the core go-to-market strategy and maybe one the company's working on or the company's moving towards. But that's about it. So all the other secondary things that you do shouldn't be in this slide. Potential outcomes is an optional slide. If you Google Uber pitch deck, we have that hosted on our website. The Uber pitch deck has a very interesting potential outcome slide that kind of talks about where the company could go. Funny enough, for the Uber deck, the best case scenario was like becoming a $1 billion company, and obviously Uber is much bigger than that. So this Uber became much bigger than their last potential outcome. I don't think it's a necessary slide, but sometimes it's a good example, and Uber is probably the best. And then TAM is probably another example. So we have a good video that goes over on our channel that goes over in depth how TAM works and how to estimate TAM. It should absolutely be a bottom-up exercise, not a top-down. We're going to paste that video in the chat and in the YouTube chat, so you'll be able to watch it from here. But in a nutshell, yes, TAM is a factor of how much money do you make from each customer and how many customers you can get. Simple as that. Simple as that is how it sounds. It's not as simple, of course, but yeah. Look out for the video from my team. We'll paste it in a sec. Okay. And then last but not least, the why us section. So the why us section, Michelle. And so I'm reading through the chat. Sorry, I can't. I'm super bad at multitasking. I'm sorry. I get caught up. But we'll have some time for questions. I think we're making good time, so don't worry. Okay, so the why us section. Why are you and your team the team to change the status quo? The this is kind of like the last conclusion, like the cherry on top, right? You've given us this fantastic business opportunity. You've told us how to do it. You've told us that you know what your strategies are. We believe you. And now prove to us that you're the team to do it. And you prove that with slides like competitors, like your competitive advantages. Why are you better? What do you understand about the market that they don't? Secret sauce. If there's something of a secret sauce that you haven't touched on or that you want to hide, now's the time. And then of course the team. Last but not least, the ask section, which I don't even call it a section. It's more like a wrap up transactional thing. Your financial forecasts, crucial. We're going to talk about that in a sec. And then last but not least, the ask. So, you can see I think we have like 22, 23 slides in total. Some of those are optional, of course. So you end up landing usually between 15 and 20 slides. Now, for all of you that had questions on the story, I'd love to know if this context seems useful. Again, we're going to have some time for questions coming up. Hopefully this helps you structure things. I think the last note I'll make on that is, sometimes we get caught up and we want to put more slides about one thing than the other thing. In my opinion, these 15 things or these 15, 20 slides that I mentioned, I think that your deck should talk equally about all those 20 things, right? So, I see companies that, for example, want to add more on the product or want to add 5 slides on the problem, right? So that makes the deck a little heavy on that side and usually causes the deck to be weaker on another side. So I think that proportionally, your deck should be like this pizza that's split into these 20 parts, and all those 20 parts are really important. So yeah, you can break the rules. For example, on a Series A deck, usually there's a lot more time spent on the go-to-market section, for example. But overall, this is a good structure. Hope that's useful to all of you. Okay, some resources on how to some resources that we have to actually take advantage of this template. First of all, on Slidebean, like on our platform, you can use either one of these 2 templates. So the one at the top we built ourselves. Like this is a proper startup pitch deck template that's based exactly on this structure, So you can do that. Sign up to Slidebean is free. And you can also use the Airbnb deck. Airbnb doesn't have all these slides that I mentioned, but they're really, really good at summarizing and compressing the content into few slides. And I think it's a fantastic deck, probably my favorite deck from all time. So that template's also available on Slidebean if you want to give it a shot. And if you want some extra help, you can also use our AI builder. So we recently launched, it's still in beta, but we recently launched an AI builder. So we basically take this structure again, just as I told you about it, and we designed our own system on top of GPT, where we sort of take your company story, we source most of that from your website, and we try to reverse engineer a deck from that. It's usually helpful as a good start. It gives you the structure right away, and it kind of writes. It does. I want to say it does 50% of the work for you, but the other 50% is still up to you. So it's AI, it's still not human level. Okay. Yeah. So all of these. Oh, by the way, sorry, and kind of like more advanced help on what we can do. The templates themselves, plus a chance to have a monthly review session with our team. That's all part of our new plan that we launched recently called Slidebean Accelerate. So the idea is you guys are working on your pitch deck. We only we are available to kind of assist through that process. So with our Accelerate plan, you get 1 monthly call with our pitch deck team, 1 monthly call with our financial team, and a kickoff call for every single customer with me. So normally, in the week 1 or 2 weeks after you subscribe to Accelerate, you'll get a link from my calendar, and we'll have a chance to chat. So normally we can do a first pitch deck review in that session. That's what I'd say half of the customers I talk to do. And then the other half, we normally talk about kind of fundraising strategy, how to move forward, and how to retell the story, and kind of more strategic approach. And then we have a whole team that can help you write the pitch deck from scratch if that's what applies. That's more like a larger consulting project. Okay, so next problem that I want to talk about solving is investor type. So Um, Big problem, big caveat with companies trying to raise money. They're going after the wrong investor. So we created this little cheat sheet. We call it the startup stage cheat sheet. We're gonna paste the link in the chats. But I'm gonna zoom out and kind of walk you quickly through it. So let's think of a pre-seed company. I always like to start there. So a pre-seed company, let's see if I can't zoom out. You can zoom in Zoom, I believe. Oh God, I broke it. And then of course we'll paste the link if you want to follow the bigger version. But yeah, so what's the pre-seed company? Well, a pre-seed company is a company that's made up of two founders that have the core skills, two or more founders that have the core skills to build and launch a product. Um, this founding team, they can build a prototype. They don't need external experience to do it. They don't need external skills. They have the core skills. They may need some extra people to move faster, but overall, they could build it themselves. Deep insights into the problem based on industry expertise, or in a clear picture of what their product is going to look like. Maybe the product isn't built, they can build it, and that's what they can prove through it. I think, Christopher, you mentioned, I think that you can zoom on Zoom, fun, no pun intended. If you kind of like, at least it works on my Mac. Like if you over the screen share, you can like literally pinch to zoom. I've done it. Okay, so they maybe started working on a prototype. Sometimes there's an initial testing prototype that's kind of working. They've talked to customers, of course, they understand what the customers are building and so on. Again, they don't have revenue, and the capital that a pre-seed company can access is normally friends and family, angel investors, or very early startup VC firms, the startup accelerators, of course. So again, pre-seed company is team formed, capacity to build a product. And when you raise pre-seed, the idea is that if you raise a pre-seed round, the next round of funding you'll have is a seed round. And a seed round, if you check out there, is a round that a company raises when they have a lot of revenue, when they've proven that the product works. So you have to understand in which of these buckets you land on. If you're missing a co-founder, and you have that in the common deal breakers column, if you're missing a co-founder, or if you're missing a skill to build your product, you're building an app, but you don't have a tech co-founder, you're not a pre-seed company. You're probably an idea stage company, and the capital that you can raise is very different. You're probably limited to startup incubators or just to bootstrapping. I see a lot of companies that don't have revenue and are trying to raise a seed round. Doesn't apply. You're a pre-seed company, because pre-seed companies are the ones that raise before a product is in the market. So targeting the right type of investor is critical. Like I think I've seen so many companies waste so much time going after the wrong investor, getting rejected, which is painful and discouraging, because you're just going after the wrong investor for the wrong stage where you're in. Now, another important disclaimer here is, you have to understand the type of company that you are, because not all startup companies, I mean, not all startups can raise venture capital. I'll give you an example case. So let's say that you want to raise $500,000. So your company, you figured out you need $500,000 to scale, and 15%, you're thinking of something like this, right? Because we've read about it on TechCrunch. It's the ranges that we usually talk about. You need $500,000. You're willing to give investors something like 15% of the company, which is pretty standard, right? So if you reverse this, right? If you say that 15% of your company is $500,000, you're basically saying that the entire business is worth $3.3 million. And then the question is, well, is your company worth $3.3 million today, right? Is it worth that? If it's just an idea, how can we justify that a company that makes no revenue is worth $3.3 million, right? Well, it's of course based on the potential, right? So, well, your business, we could argue, right, and you could agree with an investor that your business is worth $3.3 million today if there's a clear path to your business being worth $33 million in 5 years. Okay, so how could that happen? Well, maybe if you have an EBITDA margin of 6 million, that's a profit, like a net profit margin. You could argue that your business is worth that. That'd be like a 5x multiplier, which is pretty standard on EBITDA valuations. So that's one way to look at it. Maybe there's a clear possibility that someone will acquire you because of your technology for $35 million in 5 years. So that's another way to justify that valuation today. Maybe a company is willing to buy your users, right, on a $3 per user standard. This is what Facebook paid for Instagram, about $3 per user, per active user. So if that's a possibility for you, then that's a way to justify your valuation. Or can you have, are you on a path to raising a Series B that's going to give you an even bigger valuation? Or are you on a path to becoming public? If that's your path, then yes, we could argue that your business is worth 3.3 million today, so $500,000 for 15% of the company. But I see far too many startups that are building a more traditional company that doesn't have this potential for scale and that still think or aim at raising money from venture capital investors. Best example I can give you, I had a chat with founder, I think it was yesterday or the day before. Um, his company is more like a restaurant, like it operates a little bit like a restaurant. And he's trying to raise there's some tech component to it on online ordering, but he's trying to position this as a tech company with a 15% 500K round. And my first argument to him is like, is this a tech company really? Like, are you on any of these paths to scale this quickly? Because if you're not, then you have to approach a very different kind of investor. I think another example for that is most e-commerce platforms, probably, are not going to become, not all of them, but most e-commerce platforms are more traditional businesses, agencies, services, any company that has to scale their staff drastically proportionally to their revenue, probably doesn't apply to these, right? So, it's one of the core reasons why Uber is Uber, because they don't have to scale staff. The idea is that no, we're just creating a connection between driving partners and customers. Same as Airbnb, right? They don't have to own real estate to rent all of this. It's not a hotel chain. It's literally just the platform. That's what's valuable to tech investors. And of course, advanced technologies, AI, etc. Okay, so hopefully that gives you a bit of a perspective. Hopefully that helps you understand where you land. I'm curious, and I'll ask a little survey for everyone. Did did I change your mind about what stage you're in? Maybe you thought you were a seed company, and now maybe you feel more on the pre-seed bucket, or maybe you were a pre-seed bucket, or you're thinking of pre-seed, and now you felt more like an idea stage. Did that change your mind? I'm super curious. Drop me a comment. Okay, so next up, the other red flag. Let's talk a little bit about budgeting. Didn't change your mind, says Virginia. Okay, so I mean, if you were in the right track, I'm glad you were in the right track. Awesome. Okay, so little trivia question for everyone. Let's make this interactive again. How much should you raise for a seed round? So let's say that you're in a seed, you consider yourself a seed company. How much money do you need to raise? A, 18 months of runway. B, whatever it takes to reach the next funding round. Or C, enough to launch the product. What do you think? I see B from Michelle, C from Christopher, B from Raul. I see some A's, I see some B. Oh, this is a trick question. I'm glad not everybody. I mean, I'm glad there's debate about it. Okay, let's write out some options. The easiest one to write off is C, because if you're a seed company, you've already launched your product, right? Seed companies usually, at least in the software space, usually have revenue at seed stage. Exceptions to this are hardware companies and deep R&D companies, right? So a software company that's building literally like a new large language model that requires PhDs and a lot of research and multiple rounds of funding. That's they'll probably raise a seed round without revenue because it's a huge project. Okay, so we'll write off C. Now A, I'm gonna write off A because 18 months of runway doesn't guarantee that getting to the next fundable milestone, right? And I'm speaking with our own experience. Literally, one of our toughest times as a company was we raised the seed round with revenue and whatnot, and nobody had taught me this. Truly, nobody told me about this. We raised the seed round. Every single documentation I could find said, hey, you should raise for about 18 months of runway. Okay, great. I raised for about 18 months of runway. 18 months later, or 12 months later, we're like, okay, we're 6 months out. We probably have to get ready to raise money again. We had about $1 million in annual run rate, and we started going to investors, some of our own investors, some new investors. It's like, hey, I think we're ready to raise our Series A. Here's my pitch deck, whatnot. And the answer I started getting is like, well, you're not a Series A company. You're still, I mean, you're doing great, but we are a Series A fund. We invest in Series A companies, and you're not a Series A company. Why? Because, in SaaS, Series A, you normally would raise at 2 million ARR at that time. Many of them gave me like a 1.5, 2 million ARR reference. That moves sometimes depending on the ecosystem. But we were at 1, and we were not going to be able to get to 2 before we ran out of money. So we literally got stuck between seed and Series A. So 18 months is not a guarantee that you've reached the next fundable milestone. Another common catch-22 where companies get stuck is between pre-seed and seed, because if you raise a pre-seed round to build a product, you build a product and you launch it, but you've run out of money by the time you launch it, then you're not a seed company. You're still pre-seed because you don't have the traction from this product. That's a really, really bad time to raise money, where you've invested $500,000 in building a product and don't have the capital to keep the company running to launch that product, or to even get the ball rolling with customers. It sucks to be in that position, because investors expect the traction of a finished product, right? And if there's no traction, something must be wrong with the product. And well, you're not a pre-seed company anymore because you've raised money already. So that's a really, really bad moment to raise money in. So you never want to get stuck between rounds. That's where you come up with stuff called like post-seed rounds. Post-seed rounds, if you see a post-seed round anywhere, it sucked. Like, know that round sucked for the founders, because that meant that's like a down round, not necessarily a down round, but like a middle patch bridge round between one and the other, because they couldn't get to Series A with the original budget. So really crucial. B, you should always raise whatever it takes to reach the next fundable milestone. Of course, within reason, right? Of course, within a reasonable amount of, and yes, with a minimum amount of time, right? So if you say, yeah, like we'll reach, we're going to grow astronomically fast and we're going to reach the next fundable milestone in 5 months, then no, that wouldn't work, right? Because you need more time and you need a cushion and so on. And you don't want to be raising money again right after you close the previous round. Okay, so for all of this understanding of how much money you need and how much that's going to last, that's where you need budgeting, right? So I'm going to give you this actual example. So the example is, we're going to generate 700 orders the month that we launch, and then that number is going to grow 10% every month. After the second year, it's going to grow 5%. So what this guy is basically saying, and this is a real quote. What this guy is basically saying is that he's going to get 700 orders, and then next month that's going to grow by 10% or 110%. And then you just took that formula, dragged it along, and essentially generated a chart, a beautiful hockey stick chart that looks like this one for the pitch deck. Like that's what you do when you just take a number and you multiply it by 110%. You get exponential growth. That's literally what you're doing. But this is shit. This is useless, right? Because how do you know? How do you know it's going to be 10%, not 8%? How much is it going to cost? What are you doing to actually generate that growth? So let's break this down. Let's break this problem down. For every company, we assume that there's going to be revenue and there are going to be expenses, right? So the question that you want to ask yourselves as you're doing this budgeting is, okay, what is the driver of my revenue and what are the drivers of my expenses, right? Because it doesn't just come. It's not just that 10% doesn't just show up. It very rarely happens unless you have some form of virality. But beyond that, you have to go and get that 10% growth, and that getting that 10% growth costs money, right? It costs effort, team, time, which translates to money. And then, of course, some revenue, the more revenue you generate, you're going to have some extra expenses. Your servers are going to increase in price. You're probably going to have to grow your team. So how does that all compute? Like, how do these things scale? Okay, let's break it down. So of course, I'm saying orders as an example, but by orders, I could be meaning traffic, I could be meaning subscriptions, monthly active users, drivers, riders in an Uber, right? So, okay. And then the other one is, what do the orders drive, right? So the more orders you have, and orders could be, we established that orders could be anything. What do the orders drive? Well, more orders might drive more fulfillment costs, could drive more hosting costs, could drive a bigger support staff, more account managers, right? So there's a correlation between revenue and some expenses. There's a cause and effect situation going on here. So let's break down that cause and effect, and this is what we call a financial model map. I joke now that's patent pending, because our last video on the YouTube channel is why software patents are stupid. So yeah, this is not a patent thing. We didn't invent it, but I don't think that nobody called this financial model map before we did. So I guess we'll coin that name. So this is a financial model map. And then at the very, very core, the very, very basic idea is we have revenue in the middle, and revenue is a driver to something, right? So revenue drives cost. So in a financial model or in accounting, COGS is cost of goods sold. So at the very basic, if you have if you're a supermarket, the cost of the products that you sell, that's your costs, right? And the revenue is your revenue. Or if you're a subscription platform, your subscription revenue is your revenue, and then the costs are everything that scales with your revenue, like your credit card fees or your hosting costs, right? So those are tied to revenue. The more revenue you have, the more costs you have. But the question here is, what is a driver of your revenue? Because revenue doesn't just grow 10% for free, right? It doesn't just grow 10%. Something must be driving that growth, and that something probably costs money to you, and you have to budget for it. So let me give you a few examples of drivers. So a good example of driver could be paid marketing, right? So that's probably the easiest one. Search ads, display ads, retargeting, even influencer marketing, because a lot of people think of influencer marketing as some magic formula that will get them customers, but no, no. As an influencer, I'll tell you. I mean, I think the best way to think about influencer marketing, if you want to choose that path, is just like your paid marketing. If you pay a campaign for $1,000, you need to be able to recoup that money. You need to understand how many conversions per dollar happened, right? That's key to growing and to scaling and to spending in marketing responsibly, right? So anything like that, I think, would fall under paid marketing. You could also have outbound sales, right? So you could be like a B2B platform, enterprise, government, where it's outbound sales people, business development. They're going to conferences, they're cold calling, cold emailing, they're navigating LinkedIn, like they're finding their own leads and kind of like you're taking those leads to conclusion on a conversion, right? So that's an outbound sales team. And then by logic, the larger your outbound sales team, the bigger your revenue, right? So there's a correlation there. Then we have organic traffic. That could be another driver. So organic traffic would be word of mouth, SEO. Like we could group social media and all of that into a driver that's organic traffic. And then you have a KPI that you have to track, which is, well, what's my organic traffic? Maybe it grows, maybe it decreases, but you have to remember that doesn't just happen, right? There must be a team behind it, a social media team or an SEO team. And maybe the cost of that team isn't immediately proportional to organic traffic. For example, if you double your PR team, you don't necessarily double your PR reach. Or if you double your SEO team, you don't necessarily double your SEO traffic. So it's not proportional, but there is a cost tied to it. And then, of course, returning customers, right? If you're a subscription platform or even an e-commerce platform, there is an assumption that some of your existing customers, because they're in your email lists, because they're on ring, because they'll come back, right, and do another order. So these are potential drivers to revenue, but not all these drivers are created equal. Some of these drivers have a direct cost associated to them. And that's why we identify them as blue. So there's some color coding in our financial models, which you'll see in a sec. But the general idea is we have to understand what the driver is to getting to revenue and not just assume that revenue scales magically, right? So the idea with this concept of model maps is that you can now make a little bit of a flow chart just to understand how your business scales. So I'm going to show you a simple one. So simple flowchart this is an e-commerce platform. It has paid traffic and organic traffic as main drivers, right? So one of them is a direct cost to us. It's a marketing cost. The other one is organic traffic, which again, there is a cost to it, but it's not proportional, so we're not considering it a blue box. Paid marketing converts via cost of acquisition into orders, same as organic traffic to the website has a conversion rate into orders, right? And those are orders from new customers. And that gives us total orders at the end, or adds up to the total number of orders. And then, of course, total number of orders has a fulfillment cost, right? For every order, we have to ship that unit, and we have to use a box and whatnot. And then for every order, we generate, of course, revenue and an average revenue per order. And then, of course, we have to pay for the products that go inside that box, so the product costs, right? So that's the direction. Orders from new customers that come from paid marketing. But we could also assume that some of these new customers become regular customers in our platform, come back, and they make repeat purchases, and they order again. And then, those stack up to the total number of orders. So this is a very, very basic, very simple e-commerce platform. But to me, it's absolutely key that you guys can map your business efficiently, because this connects to a lot of the slides that we talked about on the pitch deck, right? Go to market slide, like this is your go to market, this right here, right? If you think that paid marketing, organic traffic, that's what's going to grow, like that is your go to market. That connects to your financial projections. It connects to your TAM. So, the only reason why we started kind of helping companies a little bit with this financial stuff is because we saw that a lot of pitch decks struggled with this. They didn't have financial projections to back up the statements that they were putting on their pitch decks. So, we feel that, one very closely connects to the other. And this is how, it could look like in the end, right? And now it's, this is the template that we have for financial modeling. It's free to download. We're going to paste it. We're going to paste the link. Yeah, so we have a bunch of little tools here, from your order margin, from your growth, use of funds and so on. And now that you've seen it, you see the color coding there, and it hopefully makes everything make more sense a little bit. Revenue gain, cost of goods sold, red, magenta, and SG&A, sales general admin, or OpEx as blue. Okay, yeah. So how can we help with the models? Forgot to update the date here. So we run a monthly financial modeling bootcamp. Just think of it as a 10-hour version of the 15-minute overview I've just given you. So we're just wrapping up a cohort this week, which started on Monday. That of course is done. But the next cohort is next month, I believe, on the week of the 12th. It should be already on our website. So we'll paste the link if you want to join on the week of July 22nd. That's the answer. Oh, Amanda was one of our alumni. So yeah, glad that this was useful, Amanda. And then more recently, we added a fractional CFO service where we actually take care of doing this for you. So we run the financial model, we update the financial model based on your actual numbers, and we have a team available, like a financial specialist assigned to your company to go over questions and make edits and build this functionality for you. So it's very much a turnkey service that stands between you and your accountant to help you run decent financial forecasts. Okay. So last note I'll touch on before I get into your questions is on the reach out side. So again, we've understood the type of investors. We've hopefully understood the pitch deck that we want to make, and what that is about. And the first warning I'll give you on the reach out side is never, ever, ever send cold emails. Do not send cold emails to investors under any circumstance. That's not the way you get in touch with investors. Ideally, if you exhaust the people that you know in your network, friends, family, and their immediate connections, and after you've exhausted that, the next step is just finding investors in your space that invest in your stage, ideally that are in your area, and you can browse the web for those investors. You have investor lists. We have our own investor finder tool on Slidebean, which you can use, which kind of helps you filter out investors by stage, by region, and whatnot. They're not our contacts. We're literally crawling the web for you to find them. But the idea is, and we don't give you their emails, even though we often find them, but we don't give those to you because people tend to spam investors, and we don't want that. And that's just not how it's done. What we give you is their LinkedIn profiles. And the idea is that with their LinkedIn profiles, you can go and find what second degree connections you have in common so that you can go and request an intro. So this is how an intro could look like. Feel free to take a screenshot of this. Obviously, you're approaching somebody that you're being nice to them, asking how their family is, and then you ask for an intro, right? So you want to connect with someone, you want to tell them a little bit of why, show that you've done your homework to understand that this is not just some random connection, and then you maybe send a little blurb that they can forward. So that helps a lot. If I get a lot of investor intro requests from friends or people in my network, and they're like, yeah, can you introduce me to this person? It's like, okay, yeah, but I can try and explain what you do. I have a good idea, but the best person to explain what you do is you, right? So it's good to send a little blurb that they can forward to them. Okay. So hopefully after these slides, we've sort of untangled the process a little bit. Warm intro, never send a cold email. You ask for permission to send your pitch deck, you get a first meeting. That's usually back and forth of multiple meetings and calls, and what we call the negotiation phase, which ends up with a term sheet, which is an agreement, a soft agreement on terms of what the round is going to look like. And then once a term sheet is agreed and signed, you move into the diligence process, which is usually 1 month or so, sometimes longer, depending on the size of the company. going through your legal contracts, your IP protection, your trademarks, your contracts with employees, your stock vesting, your cap table, all that stuff. Just to make sure that the company is in good standing, it doesn't have any weird financial compromises or anything. And then after a good, 1 or 2 month diligence process, that's where you get the money in. We made this good video. We'll paste the link as well on a better overview of what actually happens. It's an extension of today's session, if you will, especially surrounding how the diligence looks like, how the term sheet looks like, and so on. You can watch that. It's on the Startup Club channel for you guys on YouTube, so you don't have to go too far. Okay, so that's in a nutshell what we do. We try and untangle this process from pitch deck to funding so that you can go to the actual tangle in life that it is to run a successful startup. So that's another story. And we try to untangle at least the first part for you. So again, just a reminder on resources before I go to questions. Everything that I've told you about, all our templates, including our financial modeling bootcamp, our AI pitch deck builder, and these monthly review sessions, including the kickoff session with me. All of that is part of our Slidebean Accelerate plan, which is not just $99 a month. We think of it as a cancel anytime, and usually the idea is that a company goes through 3 or 4 months as they're preparing their documents for fundraising, and after that we're ready to see you guys go. It's not a plan that you're supposed to pay forever. It's more like we help you prepare through this phase. And then again, if you need help writing the pitch deck from scratch, that's where we have our consulting team to actually build a pitch deck from scratch, or run a financial modeling from scratch. Those are all my slides. I'll unshare my screen and I'll jump into your questions. So feel free to drop them by. Same. I have my live chat on YouTube here, and I have the webinar chat, so I can go through both. I see a question from Christopher, sorry. Could we address unique projections in a source of funding? How would this apply to get funding from the government as a round in obtaining globalization of government entities? So, government funding is, at least financially, from an accounting question, it's just like the other kind of funding, except that it usually doesn't have equity, unless it's like a loan, right? So a lot of government funding operates like a loan. So the model, our template has a little section where you would call that a loan funding. That's that you don't put that in a map. You don't put to say, hey, if we reach a certain amount of revenue, we will raise funding, because that's never a given, right? So it's always like a manual input that you assume that that funding is going to come, and then you forecast based on that. So not a formula by any means. I would never kind of connect an arrow to funding, because that's not usually how it works, at least the way I understand it. I see Larry on the YouTube channel. So how do you define the milestone that will get the next funding round? How do you define the difference between Series A and Series B? So back in the day, for example, when Tesla, when Tesla raised their first funding, they called their first round a Series A. Right, so there was no standard established, or at least it is an evolving nomenclature for rounds. So yeah, Tesla's first round of funding was Series A, and they had nothing, they didn't have a product, and they just called it Series A. In this day and age, it's understood that seed is a round that you raise, at least from the software standpoint, when you have revenue and growth. Series A is when you've established and have traces of product market fit, and you can sort of prove and say, hey, we have customers, they love our product, we're growing, we understand how we're growing. A Series B round is usually raised, companies should be probably in the 5 to 10 million annual run rate. In a company that's making 5 to 10 million in annual revenue, it's a very different business compared to the 2 million business, right? This is a company that understands what they're doing. They've built an executive team. They have advanced knowledge in the company. They absolutely have product market fit. They understand their economics to the cent, right? And most Series B rounds, most of the focus of a Series B round is not in product. It's mostly in growth, right? So either sales or marketing, but it's in very, very aggressive expansion. Whereas, seed and Series A rounds still assume that a good chunk of the budget is going to go to finishing the product, right? There's a product that's working, but you have to finish it. And that extends to the other rounds, to the other alphabet rounds, Series C, D, E, F. As you reach more scale, the bigger the round, the better understanding you need to have of where your company is going, whether it's going into the direction of an acquisition or an exit, because investors expect their money back, and it's not money that comes from profits. I mean, it would take years or decades to repay investors through profits. Startup investors, venture capital investors are in the game of selling companies, and that's what they're after. Okay, I see one from Raul. Anything you would recommend to adjusting the story slides if we're raising money for a venture outside the US? Well, that's a good question. As a foreign founder that I am, normally you want to raise money from investors in your geo. By geo, I mean US, Canada is a geo. Latin America is a geo. I'd say Brazil is an exception, but Latin America, I'd say is a geo. Europe is probably a geo in itself, or at least Western Europe. And the reason I kind of make that clarification is because you can't be a Latin American company raise targeting Latin American customers, raising money from US investors generally. I mean, you have exceptions, of course. Rappi is probably one of the biggest ones, but for the most part, investors like to invest in markets and in their backyard, we call it, in markets and in customers that they more directly and more clearly understand. Latin America shares a lot of consistency in how business is done. So that's a region, and it's also each one country is rather small for the most part. So they sort of have to adapt and find deals and find opportunities elsewhere. But U.S. investors generally don't invest in companies outside the U.S. with rare exceptions, and usually in later rounds, and that's probably the most important disclaimer. You do see, you saw that in Rappi, companies like Audi, there's a boom of venture capital investing in Nigeria, but they're investing in companies that have already been established, right? And they're Series A plus. Okay. Another one. I have like 8 minutes left. I don't want to make you guys late. So if no more questions come up, I'll stop here. Christopher, what would be the effective way to contact high-profile investors like Elon? No exception to what I just told you, man. It's an intro game, right? If you have an intro to Elon, you have to navigate that. If you don't have an intro to Elon, it's gonna be very hard to get a hold of him. I mean, sounds exaggerated, maybe the example, but it's by no means exaggerated. Some of the highest profile investors out there, the Peter Thiels of the world, the way you get them to invest in your company is by just knowing somebody in common, like the validation of an intro. That's why networks and building a network as a founder is so crucial, because that's how you get intros. All right. And sorry, and just adding to that, the disadvantage that comes with this disadvantage of if you're an outsider to these startup networks and to the startup ecosystems, you do stand at a disadvantage. And that's something that investors see, right? Maybe you got a hold of them, but if you have a weak network, that is a liability for the company, because it's going to be harder to raise money in the future. Okay. After how long do investors usually want their money back returns? Again, venture capital investors are not looking for profits. That's not the game. You're not going to get a better valuation by saying that you're going to become profitable. No, the game is very fast growth that leads to either a company acquisition or an IPO. First, world domination, then profitability. That's the game that VC is in. And I see one from Sunny. Hey, Caya, we're pivoting from SaaS to marketplace. We have revenue in SaaS, but it is not too scalable. But the marketplace associated with sector highly scalable. How can we include our old traction? What's your suggestion? Yeah, we've come across more than a fair share of decks that is right. Maybe a services company that's pivoting into SaaS, or in your case, a marketplace pivoting into SaaS. Normally, the way I like to approach those pitch decks is by writing a pitch deck about the new business, right? So by writing a pitch deck about the pivot, not about the previous company, and then just using the previous company as traction, validation, or secret sauce, maybe go to market, right? So like when, pitch to us the business that you're going to build, right? The new business decision. And if there's a business that you want to talk about, there's a previous success that you have to talk about. then again, find a right way to mention it to say, oh, traction. For this SaaS product, we're running slow, but for the past 3 years, we've been doing this, and here's all our traction. Here's all the customers that we got. Or, our secret sauce could be, what's this company that I was familiar with? There's this company that's doing, damn it, I can't recall. Yeah, but their previous business just plugs in exactly into their new one. So either on go-to-market or secret sauce. That's when kind of like they play that as an advantage, right? But they don't spend a good portion of the deck pitching the old business, right? Because that's the old business. It doesn't matter. All that it matters really for your future is on the lessons that it taught you and the experience that you have. So that's when it should come up. Okay. I don't see any more questions. Oh, I see. Last one, just in time. So the T market doesn't have much USP, so it'll be difficult to raise funds. The T market, is that T as in actual T, unique selling propositions. I mean, if you're a T company, I would maybe argue that you're a more traditional business, right? So you can raise money. It's just a different type of investor. There are a lot of government funds for agriculture. And it's a whole other game, right? It's very different. Like tech doesn't usually get any advantages or any breaks. Yes, some breaks, but not advantages and not funding from the government. While other more traditional businesses do. You have to understand, which of these two you're operating in. If you're in agriculture, if you're actually planting tea leaves, there's no real potential for astronomical or for exponential scaling, right? That's more unlikely. Your business is probably going to have to scale with staff, and with tangible things, land, staff, and so on. And then last one I'll take, promise last one. So Juma, I'm a college freshman. Do you have any tips on gaining trust on investors so they understand my age? Yeah, so good question. My first company, I was 21. Just I hadn't finished. I had dropped. I mean, I took a sabbatical, from college. Um, Slight disadvantage, I would say, because more than your age, it's your experience and sort of like your how mature you are. You're in the end expected to run a business and to run people and to make life decisions for people, and that requires, you know, in hindsight, looking back at myself at that age, yeah, that requires stuff that you grew up into. I think that's one. The other one is just job experience, right? If you've never had a job at all, it's hard, right? It's hard to build a company ecosystem if it's your first job, right? So I think that that's something that investors, by any means, a deal breaker, but that investors see as a negative. I met this guy, brilliant, brilliant. This is we were starting Slidebean, so he must have been like 17, 19. He had started the company like last year of high school, and then moved into college, and kind of like kept on, and like, the company picked up. Like it was doing great revenue, bunch of users. Like, obviously a product that was focused in students. Um, so that's a good exception, right? And he managed to raise a good amount of capital. Study Pool was the name of the company, by the way. Can't remember his name, but Study Pool. Yeah, the founder was a kid. I remember I was like 25, but he was like, well, who's this kid doing here, in the office? But yeah, like that's the exception, right? He built a fantastic business, was able to launch it, and investors were willing to put money into his company despite the risk of him being so young. Because he sort of, to your question, uh investors to not undermine your age. Well, if you have a fantastic product, then that's it, right? You have the advantage that if you're in college, there's a good chance your parents are helping with expenses. So you probably don't need the pre-seed round as urgently as an adult might, or as a grown up might. I'm not saying you're not a grown up. I'm saying, as a I have a mortgage and kids. Like I can't just do a pre I can't just do a company without a pre-seed round. So that's what I mean. Um, as when you're younger, you sort of get away uh with a little bit of a break in kind of getting your company off the ground, and that's when you can aim at investors for your seed round. All right, right on the clock. Thanks a lot for tuning in, guys. Hope that this was all useful to you. Drop us comments. Share the video, share the webinar if you thought that it was useful. And I'll see you. We have a bunch, so make sure stay tuned to your email for a follow up with all the links I shared, all the resources, and our next webinar coming on, I think next week.